Hey guys, welcome back. Module 3, Transaction Adjustments and Financial Statements. So, where do the financial statement numbers come from? That's really the question. In Module 2, we spent time understanding the financial statements and what they tell us about a business. In this module, we're going to step behind those statements and ask a different question. Where did all those numbers come from? Every number on a company's financial statement ultimately reflects economic events and accounting decisions that occurred during the period. Companies sell products, collect cash, purchase inventory, pay employees, borrow money, buy equipment, make investments. The accounting system captures those activities and eventually translates it into financial statements. For the MBA students here, I don't think your goal should be to become experts in bookkeeping, but what I do want you to understand is the logic behind the accounting process. When something happens in a business, you need to ask what changed, what accounts were affected, did assets, liabilities, or equity increase or decrease, and did the transaction affect income? And ultimately, how will this event show up in the financial statements? If you can think through those questions, you're going to have a much stronger understanding of the numbers you eventually analyze as a manager. The accounting process begins with business transactions. So a company might purchase inventory, make a sale, pay an employee, collect money from a customer, borrow money, or purchase equipment. Those transactions must be analyzed and recorded before the company can prepare its financial statements. So think about a very simple example. Suppose a company borrows $100,000 from a bank. What happened economically? The company received $100,000 in cash, and so assets increased. But the company also created an obligation to repay the bank. So liabilities increase. The accounting equation remains balanced, assets equal liabilities plus equity. But suppose the company uses $30,000 of that cash to purchase equipment. Cash decreases by 30, but equipment increases by 30. The total assets haven't changed. The composition of the company's assets changed, and that's an important distinction. Not every business transaction changes income, and not every transaction changes the total amount of assets. Sometimes a transaction simply changes where resources are located within an accounting equation. So the chapter is introducing the mechanics accountants use to record transactions, but as managers, I want you to begin with the economic effect. Suppose the company sells a product to a customer for about $10,000 in credit. The company has earned revenue, but it hasn't received cash. Instead, it has an accounts receivable, which is a claim against the customer. So already we see something we discussed in Module 2. Revenue and cash are not necessarily the same thing. Now suppose the customer pays $10,000 a month later. At that point, cash increases and accounts receivable decreases. But does the company recognize another $10,000 of revenue? No. The revenue was recognized when it was earned. Collecting the receivable simply converted one asset, accounts receivable, into another asset, cash. That's why understanding transactions helps you understand the financial statements. So another important relationship in this chapter involves inventory and cost of goods sold. When a company purchases inventory, that inventory initially appears as an asset on the balance sheet. When the inventory is sold, its cost moves to the income statement as cost of goods sold, or a useful relationship would be beginning inventory at whatever you start with, beginning inventory plus your purchases minus whatever you ended with at the end gives you what your cost of goods sold is. That's how a lot of smaller retailers will, collect their inventory at the end. They know what they ended with. That becomes their beginning inventory. Okay, they know how much they spent, all their purchases, and then they do a physical inventory at the end, and so the difference had to be the cost of goods sold. And so suppose a company begins with $1 million of inventory, it purchases another $8 million during the year, and at the end it still has $2 million of inventory remaining. That means $1 million plus $8 million minus the $2 million was $7 million cost of goods sold. And that $2 million they ended with will become the beginning inventory for the next month. Okay. The key idea is that the cost doesn't become an expense simply because the company purchased the inventory. It becomes an expense when the related inventory is sold. And this connects directly to the cost flow concept we discussed in Module 2. Purchases are not necessarily cash payments. Here's another relationship that can be useful. A company may purchase inventory from suppliers on credit. That creates accounts payable. So purchases and cash payments to suppliers may occur at different times. Conceptually, if accounts payable increases, the company purchased more from suppliers than it paid during the period. If accounts payable decreases, the company paid suppliers more than the amount of new purchases remaining unpaid. That's another example of why accounting information gives us insight into the operating cycle. A company may report substantial expenses without having paid all of the related cash yet. So looking at this from a manager's lens, profit does not tell you everything. Imagine you're managing a growing retailer and sales are increasing. Profit is increasing. That sounds great. But inventory is also increasing rapidly, and accounts receivable are increasing, and accounts payable are growing. What do you want to know? What you want to know is inventory growing because management expects future sales growth, or are products simply not selling? Are receivables increasing because sales are growing, or because customers are taking longer to pay? Or are payables increasing because the customer has negotiated better supplier terms, or because it's struggling to pay its bills? The financial statements give us the numbers, but management has to determine the business explanation behind them. So why are adjusting entries necessary? This is probably one of the most important conceptual parts of Chapter 3, adjusting entries. And remember that the financial statements use accrual accounting, and revenue is recognized when earned. Expenses are recognized when incurred, but many economic events do not line up perfectly with cash transactions. That's why companies need adjustments at the end of the accounting period, and there are 4 major categories I want you to understand. There's prepaid expenses, there's unearned revenues, accrued expenses, and accrued revenues. Rather than memorizing those 4 terms, let's understand what each represents. For prepaid expenses, these occur when cash is paid before the expense is recognized. Suppose a company pays $12,000 for 1 year of insurance. Initially, that $12,000 represents a future benefit, so it's recorded as an asset. After 1 month, the company has used 1 month of insurance. At that point, $1,000 of the asset has been consumed and becomes insurance expense. So the adjustment moves part of the cost from the balance sheet to the income statement. This is the same capitalization concept we've already talked about. So unearned revenue. This occurs when cash is received before the company earns revenue. Suppose a customer pays $6,000 in advance for 6 months of service. The company has the cash, but it hasn't earned the $6,000 yet. And initially, the company records a liability because it owes the customer future services. As those services are provided, the liability decreases and the revenue is recognized. The managerial lesson is simple. Receiving cash does not automatically mean the company has earned the revenue. Accrued expenses. These occur when an expense has been incurred but cash has not yet been paid. The best example is probably wages. Suppose your employees are working the final week of December, but they don't get paid. They're paid every 2 weeks. And so they aren't paid until January, the first week. So did the company incur wage expense in December? Yes. You still owe those employees for December wages. You just don't pay them until January. So the company needs to recognize the expense in December. It also records a liability called wages payable because the employees are owed money. If the company failed to make the adjustment, the December expenses would be understated and December profit would be overstated. That illustrates why adjustments matter. They affect how we evaluate company performance. So, finally, the accrued revenue occurs when the company has earned revenue but has not yet received cash or formally recorded the receivable. For example, suppose a consulting firm completes the work near the end of December but won't bill the client until January. The economic activity occurred in December. Under accrual accounting, the company should recognize the revenue in December. Again, the timing of the economic event determines recognition, not simply the timing of cash. When we talk about depreciation is another important adjustment. Suppose a company purchases equipment that will be used for several years. So as we discussed in Module 2, the entire cost does not normally become an expense immediately. Instead, the cost is capitalized as an asset. Over time, part of the cost is allocated to expense through depreciation. And one thing I want to emphasize, depreciation is not an attempt to determine the market value of the asset. It is an accounting process used to allocate the cost of the asset over the periods expected to benefit from its use. The distinction becomes important later when you're analyzing companies with significant investments in property, plant, and equipment. What happens if we don't adjust? So let's imagine management failed to record year-end wages owed to employees. What happens? Expenses are too low, liabilities are too low, net income is too high. And equity will ultimately be too high because the overstated income flows into retained earnings. One missing adjustment can therefore affect multiple parts of the financial statements. That's why managers need at least a conceptual understanding of the accounting process. If you don't understand where estimates and adjustments enter the system, you may misinterpret those final numbers. There's also temporary and permanent accounts. So the final concept that you need to understand is the distinction between these temporary and permanent accounts. So balance sheet accounts are generally permanent. Cash doesn't reset to zero at the beginning of a new year. Neither do inventory, accounts receivable, debt, or common stock. Those balances carry forward. Revenue and expense accounts are different. They measure activity during a particular period. So at the end of the period, those temporary accounts are closed, so the next accounting period begins with zero revenue and zero expenses. So the net effect of the closing process ultimately flows into retained earnings. That's another connection among the financial statements. The company's current period performance eventually becomes part of its accumulated equity. So when we start bringing it all together, at first glance, it can look like the chapter is about accounting mechanics. But I think more important, the lesson is that financial statements don't simply appear. They are the result of thousands or millions of transactions combined with accounting judgments and period-end adjustments. When you look at revenue, inventory, expenses, receivables, payables, or retained earnings, you are looking at the cumulative result of the accounting process. Understanding that process makes you a much better user of the financial information. So, in summary, what are we wanting to know from Module 3? The first thing is you need to understand that business transactions have to be analyzed and recorded before the financial statements can be prepared. Secondly, think about the economic effect of a transaction. Ask what happens to assets, liabilities, equity, revenue, and expenses. Third, you need to understand the relationship among inventory, purchases, and cost goods sold. The fourth thing you need to understand is why purchases and cash payments can occur at different times. And it's because of accounts payable, or why that happens. Also, you need to understand the four major types of adjustments, which are prepaid expenses, unearned revenues, accrued expenses, and accrued reserves. You don't need to just recognize the terms. You need to understand the timing of the cash flow versus the economic event. And you also need to understand depreciation as an allocation of an asset's cost over time, and understand the distinction between temporary and permanent accounts and why the current period income ultimately affects retained earnings. If there's one question I want you to keep asking throughout this module, it's what economic event occurred and how should that event affect the financial statements? If you can answer that question, the accounting mechanics become much easier to understand. So module 4, we're going to be making another important transition. Once we understand the financial statements, how they're created, we're going to begin using them to analyze and interpret business performance. That's why we really begin putting on our manager's lens.